Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, October 18th, 2019. Members of the site, a lot of what I'm going to cover in here will be a recap of the two videos I did earlier today, the early session update this late morning, and then the one I did a late session update. Started at 3:30, but I apologize because I wrapped in the new features on the site and didn't get it by the time I had it uploaded to YouTube and got it out to you. Market was about closed or right about there. Either way, some pretty notable developments to work on or highlight. So I'm going to start out here on the weekly time frame. We'll work our way down. It won't be a long video, but there are some things worth noting today. Bigger picture with the weekly chart. There's a 10-year weekly chart. Well, it was a 10-year. I'm zooming in now. The big levels are still the trend lines off the December 24th lows. This is QQQ, really what I care about more so than the broader market, which is a better, typically the stock market is the S&P 500. QQQ is a lot of tech stocks, but they are what moves the market. They are the market nowadays. Your only trillion dollar companies out there are tech companies. You have Apple and Microsoft, excuse me. So Apple, Microsoft, in the trillion dollar club. Amazon, Alphabet, not far behind, and they're because of that they have the highest weighting anyway. So let's just look at what's happened. So we have the trend lines off the lows on December 24th being broken down. Back here, the week ending September 27th, with 1, 2, and now third back test. You can see, again, these are weekly candles. All that matters is how you get in there at the end of the week. And we've on the daily it's sliced through, but it shows cleaner. This line shows a little more clean here on the weekly chart. You can see comes in lots of reactions on those candles, and so we're on our fourth week of back testing below those trend lines. We've tried each of the last 3 weeks. They've tried to recover it and could not close it back above that trend line on an intra-week basis. You also have the downtrend line off the highs back here in late July, I think it was, and so far that's what stopped us cold as well. And as I continue to say, coin toss odds, and being this close, we might as well just pop up and make that marginal new high and get it over with. It almost actually feel a little bit better, but we may or may not get it. I mean, that has been the MO for the last couple of years now. The market, every time it makes a marginal new high over the previous high, and I've covered that many times, shows better on the daily chart. You make a slight high, and I'm talking anywhere from less than 1% to 3%. It has been followed by corrections, marginal new high correction, marginal new high correction. So that's been the or actually that was the last one there. SPY, you have a little better series of those marginal new highs. And SPY broke down the December 26th, 24th trend line a while back tested, and put in a double top high on the S&P 500 right there, essentially two highs. Not far from it now. So again, any new high anytime soon will simply be a marginal new high, and that, in my opinion, not just because the market has a series of making these marginal new highs like right here and then correcting. Marginal new high, correction, marginal new high, correction. Not marginal new high, that one was as well correction. So that's, since this point here, 1, 2, 3, 4, and again, so it's the MO, or the modus operandi of this market. That's what it's been doing. And if we didn't have these divergences building in place, breadth deterioration, a lot of other sectors not confirming, the transportation, everything go down the line, check marks across the board. Otherwise, I'd say, hey, this looks like a potential bullish breakout with a new, leg up in the markets, meaning 10+%. I don't see that. If it happens, great. I'll try to adjust as soon as possible. I can tell you I won't adjust anything, that's within 5% of the previous highs, because there won't be a lot that will change in these long-term charts. It's impossible if we broke out in the next few weeks here. Now, if it happened down the road, the technical posture changes, then so will I. IWM, not much to say. The small caps, they peaked back in 2018, like so many sectors in the stock market, and are well below there. And same with the mid caps. I don't talk on the mid caps often, but they're an important segment of the market. They're in the middle there. And same thing, you had a divergent high here, Just like, you had these, you look for these weekly divergent highs, and that's where the big drops come from. This one's about a 25% drop in the mid caps there. This one was about the same, 25% or so. And we had a divergent high here recently, but mid caps and small caps, they're well off their highs, but they're just waiting to see where the large caps go. They're going to follow the leaders. So leaders are your, the big caps that I talked about, the Amazons, Apples, Intels, and Microsofts of the world. So we'll watch those trend lines, and of course XLK, the tech sector itself, because it's all about those tech stocks. And you can see 1, 2, just like QQQ, fourth back test, the fourth, following the breakdown, the third weekly back test of the trend line, and yet another rejection, another failure to regain it. This is the trend line right here off the December 24th lows. So that's bigger picture stuff. Now let's just zoom down to the near-term charts. In fact, let's not look at a gazillion charts. Let's just look at the 60-minute charts, and let's just stick with the tech sector. All right, so throughout the day, and actually for the last week or so, I've been highlighting this price channel. I've had it drawn out here. You can see it a little cleaner on this board. These two white lines. I'm going to go back to this one here. I have blue lines here, and forgive me for all the busyness. Let me try to just highlight those. So you have the price channel. If you haven't caught my analysis recently, right here in QQQ. It's a near-term upturn channel right there. You can see a lot of reactions on that top line, and here's your uptrend line. And as is very often the case, when I see a price channel, whether it's a downward sloping price channel, an upward sloping channel, or even a sideways consolidation range like we had back, well, it was better defined in SPY in August. But quite often you can put a midpoint line. You can use a tool called an Andrews pitchfork. It'll do the same thing. Put up the Andrews pitchfork and it's going to give you those midpoint lines. But I like to manually draw the lines, because sometimes that midpoint line is slightly, not exactly parallel to the channel, or it may be slightly above or below the midpoint. In this case, it's pretty darn spot on right in the midpoint of the channel there. And so, as I've said recently, break below that trend line, because it acts as support and resistance when tested from above or below. So you tend to trade in either the lower half of the channel, and when you break above the midpoint line, then trading resumes, and usually happens in the top half, and vice versa. And as I said before, now the takeaway from this, and this was shared today on the site, is that so far it's been a series of gaps to separate the top and the bottom of the channel. You gap up above it, and then you started trading above the channel once you got above, or you gap down below and traded below. Today was a excellent trading opportunity, because you broke down below the midpoint of the channel after the market opened. This is a 2-minute period chart. Every candle's 2 minutes. So this shows you right here. This is yesterday's close at 4 p.m. right where the dotted dashed yellow line is. Market opened down slightly today, popped up, went positive right after it opened for a hair, and then boom, it started moving down gradually. So you had plenty of opportunity. Now where that's relevant, had it gapped down halfway down or all the way down, you would not have a very objective entry, because if you gapped way down, then you'd be in no man's land in the middle between resistance, which was this former broken, now it was support, now resistance once broken, and the next support level. And so as I did the video today, in the early session, the morning session update for members, we were right here, and I told you that that although I expected a reaction, although a reaction was likely on this uptrend line, I told you that I was favoring a move down here to 190, that 190.86 support, which is that pretty big important gap support right here. Let me highlight it for you. Right there, big old gap. And that's the top of the gap. And so I said I would be riding my short down and then reversing to a long there, which I did, and then reversed the long. And as I did in the last video, and half hour before the close, I told you I reversed back short for just to run down to the close. And I told you guys I may or may not take that home. I just closed it out. I got right after the close today. Futures went down a little bit more, so round trip was about a good 3%. On NQ and QQ, or if you trade QQQ. So again, you had the breakdown right here of the midpoint of the channel, and that was followed by a drop of about almost 1.5% into the lows, which was about exactly where that that downside target was today. So it was good for a reversal to gain a bounce back into about a 1% rally up into the support level that I showed you in the video this afternoon, and then another 0.5% drop, and you got just a hair more after that in the futures. Close it out. So yeah, that's about a good 3% or so right there. Good day for day trading, and that's all it is. Like I said, it's not a swing trading market right now, because when you strip away all these lines and you go back for the last few months, this market is moving up and down, and these are active day trading ops, but at the end of the day it's going nowhere but sideways, or has gone nowhere but sideways. And the very top to the very bottom of that range is about 8% on the extremes, but most of the trades have occurred about within about a 6-7% range there. So again, anything that's indexed, your Apples, Amazons, it's very, very hard to swing trade. So that's where my focus remains. We have been bearish and short the U.S. dollar, along the euro. We have some pot stocks that we're looking at now. Just anything that's not highly correlated, generic and specialty drug stocks, things like that. Shipping stocks did great on those the last couple of weeks because they were rocking, and they have little to no correlation to the broad market. So where do we go from here? That's I'm sure what everyone wants to know. I don't know near term, but let me turn the lines back on, and as I said in the other video, here's what I think would happen. This was where we stopped today, and that's where I told you I'd reverse 192.50, because that was very good resistance right there. You can see on QQQ all the way back, a lot of reactions, a lot of gaps along here, and it meshed almost perfectly with the resistance on NQ, which is what I was trading, the NASDAQ 100 futures right there, that 7,900 level. Very, very well defined, going all the way back here, big old gap, lots of reactions along there, reaction highs, reaction highs, reaction high, reaction low from above, and then boom. So this was and I even mentioned in the other video, a little sort of like a mini head and shoulders pattern right here, and it played out to about all it was. So again, that's all I was looking for in today's drop. It's active trading stuff. I don't see a great swing trading op, and I still maintain what I've said the other day. We have the 5 or 6 most important companies out there that as far as moving the market. We had the big banks report this week, but they don't move the needle on the market anymore. It's all about the mega tech companies, and we have them all coming up, as I've covered recently, in the next week or two here. You're going to have Apple, Amazon, Microsoft, Facebook, all the FANGs, and there are, I believe, Intel as well. And so that'll be the top 6 or so largest components of the NASDAQ 100, and most of those also the top components of the S&P 500. So my point is, we're probably going to go in a holding pattern, and therefore I think it's best to keep things like we're still within spitting distance of new all-time highs. But as I showed you on that weekly chart of QQQ, so far we failed. This is QQQ right here, that uppermost trend line. That is the downtrend line off the highs. This was a high back in July, the all-time high, and or the most recent high, in QQQ, or all-time high as well. Followed by this divergent high here on the 60-minute chart, rejection there, and a couple of rejections. We tried to take it out the other day and failed. However, if you want to look at it glass half full, we had that scenario where I told you we'd probably get a reaction here, and that's exactly what happened. Although I was favoring and held out for a break of that trend line for the reasons I stated earlier, when we hit my support level where I reversed, that candle shot back up, the 60-minute chart. The price has shot up, and we closed right back effectively on the trend line. So that is a reaction. Even though we overshot it, it was an intra-period break. And if you trade a 60-minute chart, all that matters are your 60-minute candle closes. So this effectively was another reaction on that trend line right there. Even though we breached it intra-period, closed on it, and then each successive 60-minute candle today so far traded on or around that line. Where we go next week, crapshoot. I think most likely, because we've hit this channel now, we trade in the bottom half as we did back there. channel's getting a little long in the tooth. These channels do not last forever. You know, trend lines and channels don't last forever. And once they break, you either sell off immediately or you break down and back test. So that's what we'll look for next week, guys. Look for a definitive break and 60-minute close below this channel. If it happens, what I favor is we come back down and I think we'll undercut, we'll take out the top of that gap, that 90.86 support, and backfill it. And I said this in the video to members earlier, or the afternoon video. If you're short and bearish, it'd actually be a good thing near term, but bullish, there's something for the bulls as well, because if that happens, let me flip to another board here and get rid of all these lines. Let me take all the lines out. If that happens, then the market, or at least QQQ here, will not leave any unfinished business. So here's your gap right here, right? Most gaps are backfilled sooner or later. And if this market is going to go to new highs, make a marginal new high, it would be actually more bullish to see that gap backfilled. But of course, then prices reverse and not go much lower. You don't want to see that. That would be bearish. So this is what I'll be watching for next week. And I'm leaning this way. This is what I favor next week. Come down, break it down there. But I'll tell you, my convictions aren't super hot, because you still have that price channel right there that may continue to keep prices going up for a little bit longer right there. So those are the levels to watch, and like I said, when my convictions aren't high, I just don't go home heavily positioned. I'll wait and see how things start out. The other thing that stands out to me on this QQQ 60-minute chart right here is you have the PPO turning up here at the 0 line, and that's, you know, when trading's been a little whippy lately, so you've had some crosses above and below, but usually as I'm boxing in here, when you're above it and you stay at access support on pullbacks, especially that white line, the 9 EMA, and so it helps you define the trend, the near-term trend. So it was all bullish this whole time here, and you can see where prices were at that point. Most of that was up, and then we had a sell signal there, and most of that was down. And then we've crossed back above, the white line crossed above here, and the trend has been bullish since. And so I'm sorry this looks like a Christmas tree here, but that's what I'm watching. So there it is. Cross currents, divergent highs, everything else. In the first post that I put out this morning, I mentioned that the risk for correction right now was pretty good, and that can follow through into next week too, because as I said, I showed you we had divergence on the futures right here, negative divergence from this point to here. There's your divergence line. In fact, we had it all the way back here is where it started on NQ on the PPO, but the RSI divergence is right here, negative divergence. And the last time we had divergence of that scale, of that magnitude, was back here. We had smaller divergent highs here that led to smaller pullbacks, but this was our last one. We had that head and shoulders topping pattern. Remember that on the 60-minute chart right here with the futures? That head ended with the last comparable divergence, and the drop was this drop. So the odds right now, same thing I've been saying, the upside potential is limited, and if I had to be long or short and throw away the key right now, and I still have swing shorts, don't get me wrong, I'm talking active trading account, it would be on the short side. Same thing with ES. Let's see, there it is. We had the 60-minute divergence forming from here and here. So this high right here was a divergent high. You can see that, negative divergence. And the last time we had a divergent high of that magnitude was back here, and that was before that big correction. So that's what's going on here. These divergences could continue. That's the thing about divergences. Sometimes, just like the weekly ones that have been building on the market and the daily ones for a long time, you had a divergent high there. What happens? You had a relatively small correction. See right here? And then the market went on, eked out a marginal new high, but it was still yet an extension, just a continuation of those previous divergences to give you an even larger divergent high. And typically the larger the divergences, the bigger the drop once it finally comes. So right now the question to me is more so, okay, are we going to, just like on the daily charts and weekly, are these divergences going to play out for correction next week and from here? Maybe. And if not, There's plenty of room for this market to push a little higher in these divergences here on the 60-minute to continue. And again, same thing with the daily charts there as well. And to wrap this video up, the other thing that I pointed out this morning on the site before the market opened, right around pre-market today, was not only do we have the negative divergence on the stock indexes, but we have bullish or positive divergences here on these are Treasury bond futures, CB, the 30-year government bond. And these are your risk-off assets. So right now you have this nice, clean, bullish falling wedge pattern. You have a breakout, a successful backtest so far. Divergent low. There is room if treasuries take another jog down. There's another reaction low here. There's plenty of room, just like the stock market, to come down a little bit and still keep these divergences intact, or they could play out now. And if they do play out, you want to watch for a breakout of these, the short-term little resistance level here. And again, a rally in treasuries will most likely coincide with, or in some cases precede, a drop in the stock market. Sometimes the smart money will start moving into treasuries in advance of a drop in the market, because they sense it coming and are taking money out of treasuries, while the retail traders are continuing to buy the stock, the trend, the uptrend in stocks, and before the reversal comes. So, all right, we'll wrap it up here. That's those are the levels to watch and the things to watch. Again, trading the market, I don't trade it in a vacuum. I watch things like gold, the risk-off assets, equity markets. I'll watch the large caps, small caps, the big stocks, the FANG stocks, the tech sector. It all comes in together. So there's some levels to watch next week. And again, earnings are coming up. So one thing I can guarantee, you're going to probably see some choppy trading in the next week or two, and probably some pretty good gaps up or down in the market when those market leading stocks like Facebook and Microsoft and Amazon report, and they're likely to cause the market to gap up because of their heavy weighting, or down, depending how their earnings come out, and of course their forward guidance. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.